Share price is arbitrary. A $5 stock isn't cheaper than a $500 stock. It's just math. Share count. So what does dividend stocks under $10 actually filter for? Because whatever the answer is, that's what this whole video is about. 10 dividend stocks, all trading under $10 as of July 2026. Yields ranging from 6.4% to 28%. 9 of them delivered negative one-year total returns. Only one of them isn't a business development company or a mortgage rat. This is what the filter actually returns. Let me show you. 3 principles before we count down. 1. Price isn't value. Share price is share count math. A screen sorted by price is a screen sorted by nothing. 2. The under $10 filter returns business development companies, mortgage REITs, and distressed microcaps. Every one of them is a leveraged financial vehicle. Their dividend is a spread trade. Borrow cheap, lend expensive, pay you the difference. 3. A 20+% yield isn't generosity. It's the market's forward estimate that the dividend gets cut. The NAV keeps eroding, or both. The yield is compensation for risk you can't see yet. Here's how the 10 names sort. 3 moderate tier stocks, yields 6 to 15%. Coverage is arguable. The trajectory isn't. 2 stressed tier stocks, yields 15 to 20. Leverage is doing the heavy lifting. 5 extreme tier stocks, yields north of 20%. Every single one has either cut their dividend, is guiding to cut, or is being sued by shareholders. Yields climb, risk multiplies. Tier 1, the moderate zone. Starting at number 10, Flowers Foods, ticker FLO. Around $8.50 a share, 6.4% forward yield. This is the only non-financial name on the entire list. Wonder Bread, Nature's Own, Dave's Killer Bread, Tasty Cake. If you eat bread, you've paid them. Here's the coverage gap. Earnings guidance for 2026 is 80 to 90 cents per share against a dividend of 98 cents. Payout ratio above 100%. That 10% trailing yield you'll see quoted, that's what happens when the share price falls 50% and the dividend hasn't caught up yet. Flowers just got dropped from the Russell 1000. Number 9, Blue Owl Capital. Owl, 937, 10.2% yield. Blue Owl is one of the largest private credit managers in the world. Boring on paper. Here's what the last 52 weeks look like. From $21 to $937, down 56%. And in Q2 2026, 2 of Blue Owl's non-traded credit funds hit their 5% quarterly redemption cap. That's the polite way of saying more investors wanted their money back than the fund could pay out. Short interest sits at 21.6% of the float. PE of 70 times. This isn't a bargain. It's a repricing in progress. Number 8, PennantPark Floating Rate, PFLT. Around 722, 16.5% paid monthly. The most recent quarter, net investment income was 27 cents per share. The dividend is 25. Coverage, 108%. Technically covered, barely. Management's own words in the earnings call, quote, limited upside versus the current payout. That's the CEO saying, don't expect a raise. And here's what matters. The portfolio is floating rate, which means if the Fed cuts rates, the dividend has nowhere to hide. PFLT is trading at its 52-week low right now. Tier 2, the stressed zone. Number 7, Invesco Mortgage Capital. IVR, 785, 18.3% monthly. IVR is a mortgage REIT. What it actually is, a leveraged bet on the spread between mortgage-backed securities and their funding costs. Here's the amplification math. Economic debt to equity, 7.1 times. So when book value moves 5%, your equity moves 35%. In either direction. Q1 posted a net loss. Book value down almost 8%. Share count grew 25% in a single year. That's dilution. And one visual reminder of the trajectory. IVR did a 1-for-10 reverse split in 2022. Number 6. Orchid Island Capital, ORC 692, 20.8% monthly. Another mortgage REIT, pure play on agency residential mortgage-backed securities. And here's the one rare positive in this entire video. ORC is trading roughly at book value. 692 market price against a book value of 726, about 5% discount. On this list, that's unusual, but the catch. Q1 2026 was a net loss of 11 cents per share. Leverage jumped to 7.9 times. And historically, ORC issues new shares aggressively into weakness, which dilutes existing holders and destroys per-share book value. The board just expanded the buyback. That's management admitting the share price is telling them something. Tier 3, the extreme zone. Every name from here on has either cut, is guiding to cut, or is being sued. Number 5. Prospect Capital, PSEC, 226, 23.2%. One of the oldest and largest BDCs, diversified across senior debt, mezzanine, real estate. Over $1 billion in market cap. Here's the earnings trajectory. Q1 25, 19 cents in net investment income. Q1 26, 16 cents. Full year 2026 guidance, 47 cents. Current dividend run rate, 54 cents. 54 cents in dividend, 47 cents in earnings. Analysts openly writing about an anticipated dividend reset. That's Wall Street code for the cut is on the calendar. Number 4. CION Investment Corporation, CION 639, 23.5%. This is the most interesting name on the entire list. CION is trading at 639 against a reported net asset value of 1311. That's a 51% discount to NAV. In theory, if you liquidated the portfolio at reported values and distributed the cash, you'd get roughly double. But the catch is why that discount exists. The market doesn't trust the mark. Q1 NII missed at 25 cents versus 29 expected. An activist investor, Bulldog Investors, is publicly pushing management to stop making new loans and just buy back stock instead. That's how skeptical smart money is. Either the NAV is wrong or the dividend is. Both hurt. Number 3. BCP Investment Corporation, BCIC, around 750, 23% monthly. If the name doesn't ring a bell, it used to be Portman Ridge. Post-merger with Logan Ridge, they rebranded. Here's the liquidity problem. BCIC is a $93 million market cap. Compare that to PFLT at $700 million or PSEC at $1.1 billion. When anyone sells BCIC, the price moves. NAV per share dropped from 1941 to 1668 after the merger. Insider stock sale in May. Keefe Bruyette cut the target from $14 to $9 after their words. Another difficult quarter. The bid-ask spread on a stock this small eats a meaningful chunk of your yield. Number 2. Horizon Technology Finance, HRZN, 478, 23.7% monthly. HRZN is a specialty BDC that lends to venture-backed technology and life sciences companies. Here's the NAV erosion. Q225, 843 per share. Q4, 762. Q126, 698. That's a 17% drop in book value in 12 months. Add to that, 3 separate law firms are publicly investigating shareholder claims. Pomerantz, Schall, Johnson Fistel. That's a litigation cloud you shouldn't ignore. HRZN went public in 2010 at $15.59 per share, which means every dividend they've paid you back in aggregate was paid out of your own principal. And at number 1, the highest yield on the list, PennantPark Investment Corporation, PNNT, 343 per share, 28%. higher yielding sibling to PFLT. Same manager, different portfolio. More mezzanine, more equity. Here's why number 1 is not a prize. Q226 net investment income fell to 14 cents from 18, a 22% drop per share. Truist, Oppenheimer, and Keefe Bruyette all cut their targets to $4 to $5 in May, and the current 8-cent monthly distribution is split into a 4-cent base and a 4-cent supplemental. Management can eliminate the supplemental on any earnings call. A 28% headline yield is not a gift. It's the market telling you the cut is priced in and probably already booked in a board meeting somewhere. Here's what actually happened over the last 12 months. 9 of these 10 stocks delivered negative 1-year total returns. Every dividend you would have collected was offset by a bigger share price decline. The yield is not the return. The market has already told you what these future dividends are worth. You just have to be willing to hear it. So what should you screen for instead? Payout coverage. Free cash flow should exceed the dividend by 50% or more. Dividend growth history. 10+ consecutive years of increases filters for management teams that treat the dividend as a commitment. Balance sheet strength. Net debt to EBITDA under 3 times. Companies that pay dividends from operations, not refinancing. Total return, not yield. A 3% yield growing 8% per year compounds harder than a 12% yield that gets cut in half. Next episode, we go in the opposite direction. Dividend growers with the strongest payout coverage in the market. Coverage ratios above 1.8 times. 10+ year growth streaks. Starting yields in the 3 to 5% range with the durability to actually compound. If this changed how you think about high yield, hit subscribe. Episode 4 drops next week. Educational content only, not financial advice. Prices verified early July 2026. Do your own research. See you next episode.